Good evening, Mayor and members of Council. So this is going to be the preliminary results from the fiscal year end, September 30th, 2018, as our audit is still in progress, so we consider them preliminary financial statements at this point in time. So this brings us to the end of the fiscal year. Our balance sheet highlights our cash balance. We had an increase over the prior year of $3.6 million, and we analyzed that change for you. Part of it is revenues over expenditures, which I'll explain in more detail on those slides. We had a receivable decrease, which is a normal fluctuation. The due from other funds decrease of $680,000. You might recall that at the end of a fiscal year, if other funds have negative cash balance, the general fund loans the money at year end, just a journal entry that we make to report those as cleared, and they have a due to and a due from. So what the good news is that the airport no longer has negative cash balance, and they have had for several years. I'll talk about that more when we talk about airport. And also the health claims fund had revenues over expenditures to reduce the amount of negative cash that they had at the end of the year. So we'll talk about that in more detail later as well. The current assets were normal fluctuations. The current liabilities increase is just the timing of payables at a fiscal year end, and some of our payroll taxes and that at the end of the year this year were paid in October. They're not due till the middle of the month, the next month. Last year they were paid before year end, just a timing difference. We like to show you at year end the unassigned fund balance, just like we talked upstairs about the general fund reserve policy. This is the balance that we're talking about. So at the end of the year, we were at $18.8 million. That's an increase of $522,000. That shows that our unassigned fund balance is 16.3% of expenditures and transfers out. Our current policy that's on the books right now is 15%. That brings us to working days of capital of about 59 days. So I'd like to show you this chart, which shows you the history of the unassigned fund balance. So again, our current policy requires 15% of total expenditures and transfers. That brings us to just hovering around 60 days. Best practice, as we've talked about, is 60 to 120 days. So we're almost to the 60 days with the policy that we have on the consent agenda tonight. We're only short of that about $276,000. So we're within reach of being at that minimum requirement going forward. So the general fund revenues, the property tax percent collected on current year taxes was the same as last year, so good news there. Our gross receipt tax were over amended budget and a little more than last year. Sales tax revenues were over amended budget, about $100,000 more than the prior year, leveling off like we anticipated. The licenses and permits were under amended budget, $246,000. This was mainly in building permits, which you might say, why? How could that be with all of the development? We actually had more building permits as far as the number of, but we had some large projects last year, like Dick's Sporting Goods, several school buildings, and the medical office building. So that was the difference that we identified there. Oh, I didn't even have that on my slide. I'm sorry. The property tax revenue, 5-year comparison, we were $3.8 million more, and this is due to increased property values, and it was about an overall 8% increase for the city in property tax values. Our sales tax collections this year, $33.1 million. We're now at an all-time high, but again, just $100,000 more than last year, and we see that leveling out as projected. For the general fund expenditures, overall expenses are equal to amended budget at 99.96%. Most areas are at 100%, some slightly above and some below. And I did note for you here on the slide and in your packets those areas that were over or under amended budget. You can see the explanation there in general government. For fire and police, I'll just note that typically the last quarter of the year will experience salary savings, and now that we've been pushing to get police and fire fully staffed, we didn't experience as much savings there as what we had anticipated at amended budget, so we're taking note of that going forward. So that's good news. You know, they've accomplished the goals that you've wanted them to accomplish, getting their staff more fully to the full staff level. The public works budget was under amended budget. There were some fluctuations in salary or staffing changes, but we had savings on electricity, and they had increased work order credits, and that was due to more capital projects taking place. So we transfer those costs over to the capital projects. So that was good news there. For Parks and Rec, they were over amended budget, mostly in park services due to water charges and vehicle charges for repairs and things like that. On the recreational side, they were slightly over in personal services. As you will recall, we increased fees at the beginning of this fiscal year, and parks was one of those areas, recreation. So those were reviewed, and we had increased fees there to help offset some of those costs. And those costs fluctuate based on the activity or participation in the programs. Neighborhood services was under amended budget in their contractual services due to all the rain, not as much mowing going on, and then the work order credits. Our insurance, non-departmental, was under budget. This had to do with employee group insurance, and I'm going to explain that more later, but we didn't have to transfer as much to the group medical insurance fund as anticipated at amended budget. We did still transfer $500,000 from the capital projects reserve fund to help the fund, but we didn't transfer all that we had planned in amended budget. And then on the reserve appropriation, that's over amended for 380 agreements payments, just more than what we anticipated, but that's economic development taking place. And then legal fees were slightly over as well. The 4B fund, the balance sheet, you'll see the fund balance at year end is just about $1 million. That's a decrease of $5.1 million. That's planned spending on the projects that are approved in that budget. That's all about approving projects to be spent and then completing the project. So that's progress for the 4B fund. There was a slight increase in sale tax revenue and other revenues. The expenditures, we've highlighted these projects over the year. It kind of shows you in transportation, parks and rec, and the airport, the projects that took place this year. In the water sewer fund, the operating fund, working capital at the end of the year is $33.7 million. This is an increase over the prior year of $6.7 million, net income of $7 million. Our days of working capital are at 180 days, and I'll show you a slide here and explain that in more detail. Again, our revenue bond coverage ratio, the requirement for water sewer fund is 1.5. We're above that. Per the bond covenants, and we've talked about the rating agencies that they use a different measure, so we have to monitor both. We're required by the bond covenants to have the one, but we have to also keep it strong for the rating agencies, and they calculate it a little bit differently. This chart shows you that working capital balance. So it shows you the planned progress to get the water sewer fund strengthened so that we can stabilize the rates and then increase the maintenance of the system. And you've heard reports from Matt. You saw the results of the water and sewer rate study. This fund is now positioned to stabilize rates and move us forward on improving the system and then also getting ready to expand the system out on the I-20 corridor as that development takes place. So we should see the working capital begin to level off as we increase that debt service when we sell the bonds to increase the maintenance and expansion of the system. For the revenue highlights, the sales were over amended budget just by $700,000 and $2.6 million more than last year. That was due to the planned rate increase to cover the cost of water from North Texas. Our sale of bulk water was up quite a bit, and that's due to increased development. Overall consumption was up 7% more than last year, which kind of surprised me because of all the water and the rain we've had. But you'll see the chart next that a lot of that took place in the fourth quarter. We did still have a dry July, August, and September, so we saw the watering increase there. Sewer charges were lower than amended budget, just slightly above the prior year, again to cover increases from North Texas Municipal Water District. This shows you the water consumption over the last 5 years. After the drought and the recession, we've kind of leveled off now where it might be just fluctuating based on weather patterns in total consumption. But this is the one we normally show you. So the first quarter had slightly more, second quarter was less, third quarter slightly more, but then the fourth quarter was where we saw the increase in consumption. So for the expenditure side, the overall expenditures were under budget, about almost $900,000. This was in the area of finance collections and water production and water and wastewater treatment. Those were related to maybe higher credits from North Texas at the end of the year than anticipated. And we also experienced savings in electricity in water production. And then we also had the capital purchases were slightly under budget, and the reserves were over, more related to the legal fees for the rate case. The Drainage Utility District Fund, here the working capital at the end of the year is $771,000. That's a decrease over the prior year of $200,000. That was a planned decrease. Days of working capital at 69 days. We had a net loss of just about $15,000. It was budgeted to be a net loss of $174,000. The revenues were actually over budget, $231,000. This was in relation to commercial drainage charges. You might recall that January 1 of 2017, we started to bill inactive water accounts because they're really responsible for those drainage fees, whether or not they're receiving water service. So we started to bill those commercial accounts. That year we experienced just 9 months of that revenue. This year we experienced a full year of that, and so it's come in higher. And then the expenditures were slightly over budget, and then we transferred $2.5 million to the drainage projects as planned. The Municipal Airport Fund, again, this is good news here. The working capital at the end of the year is $109,000, increase over last year of $169,000. They were in a negative working capital position at the end of last fiscal year. They had net income of $164,000. Hangar rentals were up from the prior year. Fuel sales dollars were actually lower or higher, but then the gallons sold were lower. That is always a fluctuation of the fuel cost. And the goal there is to maintain a profit margin. So the airport fund was able to maintain 30% profit margin, which was right on target. Overall expenditures were less than budget by $175,000. So this, like I mentioned, on the general fund balance sheet, this is the first time in several years the airport fund has had a positive cash balance at year end. So that's very good news. This is the chart of the gallons sold. We're going to change this for next year. We're going to show you, this is total, so we're going to split it out next year between the Jet A. This is Jet A. It's corporate activity, which is really what supports the operations of the airport fund. They actually had a slight decrease of 2.29%. Where the avgas, which is for recreational aircraft activity, that had a decrease of 19.3%, but not as much revenue is generated there to support operations. It comes from the corporate side. So we'll change that format going into this current fiscal year for you. The municipal golf course. So they ended the year with working capital of $184,000. This is the first time we've presented a balance sheet for the golf course fund. If you'll recall, last year was the first year we made it its own fund, so we didn't really have a measure from one year to the next of the balance sheet. Excuse me, now that we have that, we'll be showing you the working capital. They actually had a slight increase. They had a net loss, and I want to clarify one thing, that the preliminary financials that Elizabeth used in her fourth quarter report showed $18,000, almost $19,000 of net income, and that was the results of operations. We have year-end entries that we have to make, so I wanted to give them credit. They had a very good year in spite of having approximately 25 days of closure due to bad weather and other circumstances. So their overall revenues were up, their rounds of golf were up, and their expenditures were 1.1% less. So they did a good job to manage their expenditures and keep their operation in check. We just kind of hit them sometimes with those year-end entries, and they don't really like us for that. But it's entries that we have to make to close the books for the year. So that was a good results there. This chart just shows you the rounds of golf. I think only the second quarter showed a slight decrease, but then the rest of the quarters were all more than the prior year. The group medical insurance fund. So here, this is where, we have the work to do on the fund balance. It was negative at year end of $4.7 million, but that was we improved that. We decreased that negative amount by $380,000. The employer contributions would show on the financials that it was less than amended budget. That's, like I said, we didn't have to transfer as much of that additional amount as we thought. The employee contributions were less based on more employees selecting the HSA plan, and then the copay at the health clinic was less due to less activity at the clinic. On the expenditure side, this is the very good news. The overall expenditures were $1.6 million under amended budget. The claims were actually less than under amended budget and less than the prior year by over $600,000. Pharmaceutical under budget by $543,000. And our HSA contributions, we made a change in the timing of those payments, so we experienced some savings this year of $235,000. So, in the policy that we put before you in the pre-meeting, that's to help us strengthen this and get that fund back in shape. So, but good results this year. And this chart shows you how the 2018 claims are the lowest in the last 3 years. Where there was only one high claim in fiscal year 18, where in the previous year there were 7, and the year before that were 3. So that was a good results this year. On the general liability fund, this is another one where we've had a negative fund balance we've been working on turning around. Yes.
I have a question.
Yeah, but can we go back to the health insurance
Yes.
just for a second there?
The chart or
Where you were just a second.
this one, the chart? Okay.
Yes. I was just kind of curious, and I know it's probably early, so this question's either for you or Mr. Kahili, but where we're at right now, based on what we did this last budget and where we may be going this next budget, if the appraisal increases come in well for us and the economy continues to hang in there this next year, do we talked about or anticipated that we might be able to do a little bit more for our retirees this next budget? I know we couldn't do a COLA increase. We had to do a little extra increase on, the pre-65 for health. So I was just kind of curious if we discussed that or how it might be looking so far.
It's a little premature for this current budget year, but those are definitely goals that are on our minds, and we're going to make sure that those are top priorities this year.
Great. I appreciate that. Thank you so much.
Okay. So on the general liability fund, the fund balance here, again, it was more of a negative. We improved that by $523,000 this year. The revenues were slightly more than budget by $87,000, but the expenditures overall were less by $177,000. So you can see the variations there in self-insurance premiums. The workers' comp and general liability and reserve adjustment, you add all that together, it was actually less than last year by $212,000. So again, good progress on that negative fund balance for the general liability fund. For the hotel occupancy tax fund, the fund balance at year end is $1.7 million. That's an increase of $515,000. Revenues were $108,000 more than the prior year. That's a 7% increase. Expenses were under budget by $255,000. And keep in mind, in this fund, the money in the fund balance is available for future year spending and projects that qualify for spending in the hotel occupancy tax category. We always show you the chart that just shows you the activity for each quarter. Only the first quarter being less than the previous year. All other 3 quarters for this year were more, an overall increase of 7%. And then we always show you these other 2 charts, the quarterly average daily room rate, and it's the change from one quarter last year to the same quarter this year. So you can see, and Mesquite is in the orange, Dallas is in the green, and the state of Texas is in the burgundy color. So you can see the changes there. We've talked about this before. We've shown you this, and then we show you the next one is the quarterly occupancy rate, and we show you the percentage change for those quarters there as well. We are looking at some maybe different ways to show you the average daily room rate. So we're going to maybe have some ideas of how to give you some more detail on this that would maybe be more relative to Mesquite's operation. So we'll bring that to you. And I know the Jessica in the Convention and Visitor Bureau is making a lot of progress in this area. So she has some ideas to help give you better information for the hotel occupancy tax fund. So with that, I would answer any questions.
Very good. Thank you. Do you have any questions for Ms. Moles tonight?
Debbie, I do, but thank you for the comprehensive report here. A ton of information that you've painstakingly put together and presented. I kind of want to come at you from left field, so forgive me. Mesquite was a little bit slower than some of our North Dallas competing cities coming out of the recession. And once we did, we started to realize property value increases of 10%, 11%, 12%, especially for residential areas. How much of that do we realize before it's capped and then pulled over to the next year?
That's a 10% cap, so an individual's home.
Right.
So it's based on individual property. Okay. So a residential property cannot increase more than 10% in 1 year.
Right.
So then there's a carryover. So the next year, we can capture more of that, but it is capped at 10%. Well,
my question to you, and this probably isn't fair at this particular moment, but help me understand what the implications would be if the Tea Party fringe down at the state legislature is able to cap at 2.5%, like they're suggesting. What kind of impact does that have on our revenue going forward?
Right. So that would restrict how much we can recognize the increase in the values, because it's compared to the same properties, what revenue the same properties last year generate compared to the same properties in the new year. So you're capped at 2.5% of increase without, well, we're capped, but it can go to the public for what they're proposing. We don't know what they're really going to propose, but what maybe is on the table is a cap that without voter approval, required voter approval. So right now there is a rollback calculation, a rollback cap. That's what it's called, a rollback tax, and right now it's at 8%, but it's not a mandatory election. It's a voluntary election that the citizens would call for. What has been discussed is lower cap, 2.5, we've heard 4, we've heard 6 over the years, and then making it a mandatory election.
Mr. Kahili had a
Yeah,
comment.
Mr. Casper, that is a very significant concern for our municipal finances and for the taxpayers. And so as part of our legislative effort, we are going to prepare a kind of a broader briefing for council as the legislature kind of gets into action, so we can kind of respond to what we're seeing as the proposals are.
Well, I appreciate that. One thing I would say is, as we have conversations with our neighbors at the grocery store, one metric that would be really helpful for us is to be able to say what impact it would have, in real dollars to our budget, what kind of services would have to get cut. When you start talking numbers in millions and tens of millions, it doesn't seem real, right? But when you start talking about the number of staff people, the number of initiatives, I think that would be really helpful for us to go out and talk to our neighbors about what would exactly be implications if something like that were to go through. So, if we can convert it not just to big numbers, but to real that you can get your hands on, I think that would be helpful for our discourse. Thanks.
Any other questions for Ms. Moll? All right. Thank you. Very good presentation. We appreciate it.
Thank you.